Rohr here with an early, concise highlight on Wednesday, July 2nd, 2014. And it's going to be concise today because after the very nice move in the U.S. equities yesterday and some adjustment in the fixed income, the foreign exchange that we covered at length based on its renewed activity yesterday is pretty much the same as discussed there, so please refer to Tuesday morning's concise highlights for any of the foreign exchange extended chart views, although we will be mentioning that later. But we start by reminding everyone that the global data on Tuesday, the top of the quarter, key top of the month data, was kind of mixed. And the U.S. data was actually outright weak across the board. So that was very interesting because, of course, of the push up, as you can see in the equities, even as that data hit after the U.S. opening, didn't seem to matter. We are not necessarily in a bad news is good news market, but we're in, at least for the first part of the month, in inflows into equities, typical beginning of the quarter pressures, along with the idea that central bank accommodation means bad news is at least not really bad. We saw almost no overnight data internationally today prior to some much bigger influences tomorrow. One thing we will say is the Eurozone producer price index was weaker than expected. And of course that's helping to keep yields in Europe under pressure. Today we're moving into, it's currently about 7 a.m. Very shortly, we are going to see the ISM New York factory orders. There's also the ADP employment this morning, but our question about the ADP is, who cares? That normally comes out 2 days before the U.S. employment report, gives the market time to digest it. With the U.S. employment coming out tomorrow morning into a holiday shortened session, I have a feeling the ADP is just not that much of an influence, and people are just going to wait and see what we get from the ECB. The press conference starts about the same time, 7:30 Central Time, tomorrow morning, Thursday, and that's about the same time as the employment report hits. But with the ECB just having made a significant move at the last meeting, our view is that they're just going to reconfirm they're sticking with their accommodative program. Nothing big is going to take place, so the real focus is going to be on that U.S. employment report into a shortened session. Now, looking at the short-term view of the S&P future, another reason why this is a concise highlight, sometimes once markets are really on the move, the discussion becomes more straightforward. And that's exactly what we've got here today. We noted yesterday, prior to the opening, the market was already up playing around. There's the hourly chart on the left, 30-minute chart on the right, SEP S&P future with the indicators below. Pardon me. And we already noted that this was a key downside reversal and channel down break. That was a week ago Tuesday, back on the 24th. Market set a new high, closed lower from the 1953. The tolerance of this downside reversal was that 1955.5. Looked pretty stale for a couple days, but the bears could never get it back below the overrun, and this is critical, the overrun upside objective from the runaway gap that occurred coming back in from Memorial Day in late May. And once you overrun a gap, react below it, once you're back above it, big burden of proof on the bears to show the 1938 upside objective was not short-sighted. On current form, with the near-term resistance also negated from a gap on the opening yesterday, gapped above the 1953 to 55.5 downward closing price reversal signal and tolerance, and the down break on the channel, that just set the market off on an upward swing. Now, what's also important, as we also like to look at, especially on the hourlies, although you can see it on the 30-minute as well on the right, that from right after the first hour, from beginning after 9:30 U.S. time when the market held up, the hourly MACD escaped its upper runaway band. And that is similar to what we saw, of course, on the 30-minute MACD slightly later, and that just typically puts the bulls in the driver's seat for a while. Now the question is, driving the market up to where? And in the first instance, and we'll get to this shortly on the intermediate term charts, 1971 is the top of the weekly channel. 1965 is the important oscillator resistance. So it hit a big resistance up here, reacted to an important intermediate term area. And that about does it for the short-term view of the S&P 500 future. Headed over to the intermediate term view, we can see several things. Number one, here's last Tuesday's downside reversal on the daily chart. New high, lower close. Previous close to the previous trading high are your respective signal and tolerance, which it respected for several days. Held up very well on Monday, though, right before the start of the new quarter. That kind of presaged things, up in a resistance area but not attracting selling. And yesterday's gap higher puts it out to the upside. And you can see that this major channel up here, and this is very major, this is the overall up channel since the low back in 2011. The major October 2011 1068 low. These bumps up near the high end of this channel are challenging, where the market is not just maybe not going to react back down, but if it gets out to the upside, it's an acceleration signal. And at that point, the next oscillator resistance is not till up around 2000. So at this point, any pullback into the mid-1950s support, 1965 to especially 71 key resistance, with the next targets on the oscillator up at about 1990 to 95. But the fact is, come out of that major channel, you may be headed well above 2000 before the acceleration exhausts itself.